Have you ever wondered why some people seem to make a fortune in the stock market, while others struggle to break even? A question that often stirs the minds of many. The intrigue of investing is a path filled with countless decisions, each holding the potential to shape our financial future. Every investor has beckoned the answer to the question, what should I invest in? One such decision is choosing between indexing and stock picking. These are two distinct strategies, each with its unique allure and challenges. So I asked Chat GPT, based on total lifetime returns, volatility, and the total time that the index has been traded at a point-to-point loss, what is the best index for the average investor to buy? And you won't believe what it recommended. Stick with us and tap that like and subscribe button for more of these insights. Let's start by making sure we understand indexing, mutual funds and ETFs, and individual stocks as investment options. It's a strategy championed by the likes of Warren Buffett, who once said, "A low-cost index fund is the most sensible equity investment for the great majority of investors." The choice between indexing and stock picking isn't just about strategy. It's a reflection of one's investment philosophy. It's about whether you believe in the wisdom of the crowd or the insights of the individual. It's about whether you prefer the steady, broad-based growth of indexing or the thrill and potential rewards of stock picking. Choosing the right index is like choosing the right dance partner. It can guide you through the waltz of the market, helping you navigate its highs and lows. But how does one choose the right index? And why is it so crucial? One important stance to take is whether you fancy yourself a professional individual stock selector, watching the market constantly, or if you are a more passive investor that would plan merely to check their balance monthly. I would highly suggest seeing some other resources on whether stock picking or index investing has shown favor historically. We will place some interesting resources in the description for your review. Now let's take on mutual funds and ETFs. Mutual funds are a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. This pooling of resources allows investors to achieve a level of diversification that might be difficult to attain individually. ETFs are similar in structure with them, in that they usually own a basket of stocks, but trade on the market as a stock and can be bought or sold intraday, whereas mutual funds trade at market close only once. The magic of mutual funds lies primarily in their structure. Managed by professional fund managers, these investment vehicles aim to generate high returns while mitigating risk. Fund managers are seasoned veterans in the finance world, using their expertise to make informed decisions about where to invest the pooled money. They meticulously analyze market trends, economic indicators, and company performance to select the right mix of investments. One of the key advantages of investing in mutual funds is instant diversification. With one single purchase, you gain exposure to a wide array of securities, reducing the risk associated with putting all your eggs in one basket. Remember, diversification is not about making money, it's about protecting what you already have. Another advantage is the affordability. Mutual funds allow you to own small pieces of many different assets that you might not be able to afford individually. This makes them an accessible option for investors with varying budget constraints. Additionally, mutual funds offer convenience and flexibility. They are easy to buy and sell, and most come with the option of regular investment or withdrawal plans. This makes them a popular choice for both beginner and seasoned investors. A point to remember, however, is that like all investments, mutual funds come with their own set of risks. The performance of a mutual fund is directly tied to the performance of its underlying assets. Therefore, a decline in the market or poor decision-making by the fund manager can lead to a decrease in the fund's value. In the wise words of Warren Buffett, "Do not put all eggs in one basket." This is the essence of mutual funds. Spreading out your investments to minimize risk and maximize potential returns. Hang with us as we will reveal what ChatGPT recommended for us a little later on, as it may surprise you. And what about dividends? How do they work within mutual funds? Let's dive into dividends. Essentially, a dividend is a portion of a company's earnings that is distributed to its shareholders. Think of it as your share of the company's profit pie. Now, the size of your slice depends on the number of shares you own. The more shares, the bigger your piece. But how does this translate within a mutual fund? Well, mutual funds are made up of a pool of stocks from various companies. When these companies pay dividends, the mutual fund collects them and, in turn, distributes them to the mutual fund shareholders. This distribution usually occurs annually or semi-annually and can significantly enhance the overall return of the fund. But here's where it gets a bit more intricate. When a mutual fund distributes dividends, the net asset value, or NAV, of the fund decreases by the amount of the dividend per share. This doesn't mean you're losing money, though. It's simply a shift from one pocket to another. The value of your investment remains the same, but now a portion of it is in the form of cash dividends. Now, as an investor, you have a couple of options when it comes to these dividends. You can choose to take the cash, which could be a nice little bonus if you're looking for regular income. Alternatively, you can choose to reinvest those dividends back into the fund, buying more shares. This can be a powerful way to compound your investment over time. Dividends also offer a bit of a safety net. When stock prices tumble, dividends can provide a steady stream of income, cushioning the blow a bit. This can make dividend-paying mutual funds particularly appealing during volatile market periods. In essence, dividends are more than just a cherry on top of your investment sundae. They can be a significant contributor to your overall return, providing both income and potential for growth. As the great Warren Buffett once said, do not take yearly results too seriously. Instead, focus on 4 or 5 year averages. Dividends can be a powerful component of your total investment returns. Hold with us as we reveal the Chat GPT recommendation at the end. But how can you ensure you're not putting all your eggs in one basket? This question brings us to the heart of our discussion, the importance of diversification. Imagine you're at a buffet. You wouldn't just pile your plate with pasta, would you? No, you'd want a bit of everything, some salad, some protein, a little dessert. Similarly, when it comes to investing, it's crucial to have a mix. A well-balanced portfolio, like a well-balanced meal, can lead to healthier financial outcomes. Knowing what the holdings are inside a mutual fund is like reading the ingredients list on a food package. It's essential to know what you're consuming. After all, a mutual fund is a collection of various investments, stocks, bonds, and other assets. The combination of these holdings determines both the potential returns and the level of risk in your portfolio. Think of it this way. If you invest heavily in a single sector, let's say technology stocks, and that sector takes a hit, your portfolio will suffer significantly. But if you have a diversified portfolio with investments spread across different sectors, you're less likely to be severely affected by a downturn in any one area. In the words of the legendary investor Warren Buffett, wide diversification is only required when investors do not understand what they are doing. But let's be honest, the world of finance can be complex. So, until you can predict the future with absolute certainty, diversification is a sensible strategy. So, how can you diversify? By investing in a variety of assets, equities, bonds, commodities, real estate, the more varied the better. And by geographical diversification too. Don't just invest in your home country, look abroad. Different markets respond differently to global events, and this can help manage risk. By spreading your investments, you reduce the risk of significant losses. It's like an insurance policy against the unpredictable nature of the markets. And while diversification can't guarantee profits or protect against loss in a declining market, it can help you ride out the highs and lows. Diversification is key to managing risk and maximizing returns. So diversify your portfolio, and you can feast on the potential benefits of a balanced financial diet. So, what have we learned today about investing, mutual funds, and the importance of diversification? We've discovered that when it comes to investing, choosing between indexing and stock picking is a critical decision. By opting for an index, we're essentially buying a small piece of the entire market, thereby spreading out our risk and potentially reaping consistent returns over the long haul. We've also explored the intricate workings of mutual funds. These investment vehicles pool money from numerous investors to purchase a diverse array of securities. They offer an excellent way for individuals to gain access to professionally managed, diversified portfolios that may otherwise be out of reach. the role of dividends within mutual funds has also been a key part of our discussion. As these funds earn income from their investments, they typically distribute these earnings to investors in the form of dividends. These dividends can then be reinvested, creating a compounding effect that can significantly boost returns over time. And let's not forget the importance of understanding the actual holdings within a mutual fund. This knowledge is critical for ensuring we have a diversified investment portfolio. By spreading our investments across different asset classes, sectors, and geographical regions, we can mitigate risk and enhance potential returns. Investing is not a game of chance, but a science that requires knowledge, understanding, and strategy. Whether we opt for indexing or stock picking, understanding how mutual funds and dividends work and ensuring our investments are diversified are all crucial components of a successful investment strategy. But what did Chat GPT conclude? It recommended VFX, SWPX, and FXI, all S&P 500 tracking indices, earning about 10.5% as a lifetime annual return, with the longest point-to-point loss duration of over 5 years from 2007 to 2013. So, with all of that high-powered computation, it still took the most well-known index as its recommendation for your base to build the rest of your assets from. Thank you for taking the time to enjoy the content.